Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Prologis Inc., ticker PLD, the undisputed global leader in industrial logistics, analyzing their Q3 2025 financial performance and radical strategic direction. We've consolidated an enormous stack of sources here, everything from granular balance sheet mechanics to detailed projections on their ambitious pivot into data centers and renewable energy. Our focus today is not just summarizing the report, but performing a deep dive to distill the fundamental investment reality from the current market enthusiasm. Our mandated thesis statement for this deep dive is clear. Prologis is the essential infrastructure firm that leverages its A-rated balance sheet and MTM growth engine to dominate industrial logistics while pivoting into the high-risk, high-reward blue side strategy. This analysis will determine if its current premium valuation is justified by its defensive moat and aggressive, future-focused capital deployment.
That thesis really hits the nail on the head. It captures the fundamental tension of this company right now. You've got this rock-solid defensiveness on one side, and then this extraordinary, almost aggressive growth ambition on the other. For far too long, I think, PLD was simplified by analysts and investors as merely a landlord owning concrete boxes.
I think they're sheds, big sheds.
Exactly. But the reality is that the company is far more integrated into global commerce than those simple terms suggest. It truly functions as the central nervous system for global trade. There are credible estimates suggesting that nearly 9% of global GDP flows through its vast network of properties annually. So our mission here is to move past the physical real estate and really uncover the powerful engine driving its transformation into a true, essential global infrastructure giant.
Okay, let's unpack this then. Starting with what makes the core logistics business seem almost unassailable. The structural moat and that mark-to-market the MTM engine. The sheer scale is where we have to start, I suppose. PLD owns or has investments in approximately 1.3 billion square feet of space. That's across 20 countries, reported on an owned and managed, or O&M basis.
It's almost hard to visualize, isn't it?
It really is. To put that 1.3 billion square feet into a perspective that sticks, that's roughly enough space to cover all 5 boroughs of New York City multiple times over. But the key isn't just the size, it's how strategically that space is located.
Exactly. That's the critical point. The true moat isn't just the total square footage, it's the quality and, crucially, the scarcity of the location. PLD deliberately focuses on what they call irreplaceable infill locations.
Irreplaceable. Okay.
Yeah. These are the true geographic choke points. We're talking areas near dense population centers and critical infrastructure nodes, like the ports of Long Beach, which handle, nearly 40% of U.S. containerized trade. Or think about the massive railroad hubs in Chicago. These locations are virtually impossible to replicate today. You've got stringent zoning regulations, massive infrastructure costs, and just profound land scarcity. You can't just build another one.
And this scarcity, this irreplaceability, it translates directly into the company's exceptional, almost non-negotiable pricing power. This is captured by what they famously call the 5% rule.
I think this concept is probably the absolute core of the PLD investment case, right? Because it fundamentally redefines the entire cost structure for their thousands of tenants.
It absolutely does. You have to look at the tenant's total operational expenditures.
Yeah.
For a major e-commerce or logistics firm, the rent they pay to PLD is actually a marginal fraction, typically only about 3% to maybe 4% of their total logistics and operational costs.
Only 3 to 4%.
Wow.
Yeah, the overwhelming majority of their budget is dominated by transportation, labor, inventory management, all that stuff. The 5% rule demonstrates that if PLD provides a location so optimal, so strategic, that it helps a customer save just 1% on those critical transport and labor costs, while that 1% saving translates directly into a massive 17% increase in what the customer can afford to pay in rent for that property.
Okay, let me get this straight. So for the tenants, paying a premium for a PLD location isn't really a cost center they're trying to minimize. It's more like a strategic investment that aggressively maximizes their operational efficiency. It almost functions like an insurance policy against, catastrophic disruption.
It's risk mitigation wrapped in a strategic decision.
Absolutely.
Consider a major car manufacturer reliant on just-in-time inventory. If their parts don't arrive because of some logistical choke point, the cost of shutting down a production line can sometimes run from $2 million to $4 million per hour.
Per hour, okay.
When you're facing those kinds of stakes, the reliability, the speed, the efficiency afforded by a prime PLD location becomes invaluable. That cost of failure makes the marginal increase in rent entirely justifiable. And, it ensures extreme customer stickiness and further strengthens PLD's moat against any new entrants trying to compete.
That structural advantage leads us directly into their financial secret weapon, as you might call it, the mark-to-market or MTM growth engine. This is the embedded contractual growth that is already locked into their balance sheet, just waiting to be realized. It comes from older leases signed years ago, often maybe 7 to 10 years ago, before the massive supply chain shocks and the accelerated e-commerce demand drove current market rents sky high.
This MTM is arguably the single biggest driver of predictable, non-cyclical future net operating income or NOI growth for the firm. It's huge. As of the end of Q3 2025, the current lease mark-to-market spread is approximately 19% across their portfolio, and that's calculated on a net effective rent or NER basis.
NER basis, right? That accounts for things like free rent periods or tenant improvements. Gives it a true economic picture.
Exactly. So that 19% spread is effectively free, kind of baked-in growth, just waiting to be realized when those old, cheaper leases roll over.
And what does that 19% spread translate to in terms of, quantifiable value for investors over the coming cycles? Is it significant?
It's very significant. That potential represents roughly $900 million in additional future NOI potential. To put that $900 million into context, that's a massive stream of revenue that will be captured pretty much automatically as those older, cheaper leases expire and are reset to current market rents over the next several years. And what's truly fascinating is that we aren't just projecting this conversion, we are seeing it convert dramatically right now. In Q3 2025, the rent change on new and renewed leases was, it was a staggering 49% on a net effective basis.
49%. Let's just pause on that number for a second. 49%. That figure isn't just growth. That represents a massive rapid transfer of value from the tenant base straight onto PLD's balance sheet. What was the average rent growth in industrial real estate, say, a decade ago? Maybe low single digits, 2–3%.
Precisely. Maybe. That 49% rate of growth in Q3 is unprecedented. It's fundamentally different from the, 2% to 3% annual growth industrial logistics used to experience back in the day. It dramatically demonstrates the immediate powerful capture of that upside potential. It proves that the MTM story is converting directly to revenue now, and it provides a massive sort of non-cyclical buffer. In fact, it's almost counterintuitive. But if a tenant unfortunately goes bankrupt, the spread between the old rent and the current market rent is often so vast, sometimes upwards of 60%, the tenant churn can sometimes become a positive financial event for PLD. They just immediately reset the lease at a far higher market rate.
That's the ultimate defensive strategy, isn't it? Okay, now, let's transition to the foundation that underpins all this stability and allows them to make these high-conviction, maybe high-risk strategic bets, their financial fortress, pillar two.
Right. The balance sheet. Its strength is non-negotiable here. They maintain an A credit rating from S&P and an A2 from Moody's. Now, for the listener, you need to understand that an A rating is exceedingly rare for a REIT, a real estate investment trust, which often relies on higher leverage.
Much rarer than for, say, an industrial company.
Absolutely. This A rating provides a critical defense against volatile capital markets and frankly acts as a massive competitive advantage.
And that superior credit standing, it translates directly into extremely favorable borrowing costs, right? It allows them to finance their enormous portfolio relatively cheaply. When we look at their consolidated debt profile, it seems almost bulletproof against short-term interest rate volatility.
That insulation comes from two key factors, the rate and the term. Their total consolidated debt, which is about $35.3 billion, carries a remarkably low 3.2% weighted average interest rate. And crucially, they have locked that capital in for the long term. We're talking a weighted average remaining maturity of 8.6 years. Some calculations put it closer to 9 years, depending on how you factor in shorter-term debt.
Wow, 8.6 to 9 years at 3.2%.
Yes. They have locked in cheap capital for nearly a decade. That gives them immense stability and predictable debt servicing costs, regardless of what the Fed does in the short term.
So if the Fed keeps rates high for longer, as many expect, this legacy debt structure becomes probably their biggest protective shield. And this financial strength, it also provides tremendous optionality for acquisitions and strategic deployment, doesn't it? Allows them to act almost like a predatory buyer when others might be struggling.
Absolutely. Their liquidity situation is, frankly, enviable. Total available liquidity at the end of Q3 2025 stood at an impressive $7.5 billion. Now, this is comprised of $1.2 billion in cash just sitting on the balance sheet, plus another $6.3 billion available through their revolving credit facilities.
That's serious dry powder.
It is. That is dry powder that few, if any, competitors can match, ensuring they can execute their expansion plans without financial distress.
And when you look at the recent operational results, they seem to confirm that this financial fortress is supporting excellent operational performance even during this period of macro uncertainty.
Indeed. Cash same-store NOI growth, which, measures the growth in rental income from properties they've owned for the same period, was a robust 5.2% in Q3 2025. This shows continuous, healthy internal growth. Simultaneously, occupancy remains exceptionally high at 95.3% for the O&M portfolio, still very strong.
That high occupancy is critical, I think, because it tells us two things. First, obviously, it ensures steady revenue flow. But second, 95.3% occupancy is approximately 290 basis points of outperformance compared to the general market average. That suggests very clear flight to quality, wouldn't you say?
Definitely. Major tenants seem to be consolidating their operations into PLD's infill irreplaceable locations. Even when the overall industrial market might show some signs of softening elsewhere, they want the best spots.
And that confidence is reflected directly in management's guidance, isn't it? They actually updated their expected full-year core FFO guidance.
They did. FFO, funds from operations, being the primary earnings metric for REITs, they issued a guidance raise, in this environment, to a tight range of $5.83 to $5.86 per share, and that excludes promotes.
Raising guidance during a period of macroeconomic ambiguity, caused by policy shifts and tariff discussions, that's a pretty significant statement of expected durability, isn't it?
It really is. And it's largely powered by that MTM engine conversion we were just talking about. That's giving them the confidence.
Okay, so that financial stability allows them to dominate the physical world of logistics. But here's where the story gets, well, really interesting, I think. The pivot that potentially transforms them from just a landlord into a global infrastructure giant. The blue side strategy. Growth drivers and strategic upside.
The blue side strategy, yeah, that's their term for moving aggressively into these high growth, maybe higher risk opportunities that leverage their existing land footprint. And they're focusing primarily on two things: data centers and energy infrastructure. It really begins with their development pipeline, which is accelerating rapidly.
Give us the scale of that acceleration. How fast are we talking?
Well, the development engine is massive, and it's also highly selective. Consolidated development starts, which they measure by total expected investment, or TEI totaled $2.0 billion TEI just for the first 9 months of 2025. That's a significant jump compared to previous periods. Management clearly sees sustained future demand, leading them to actually raise the full-year development starts guidance to an implied range of $2.75 billion to $3.25 billion. So they're stepping on the gas.
And the quality of that development seems key here, too. The composition of that activity, it signals major customer commitment because, I read, a massive 68.3% of these starts were build-to-suit projects.
That's right. And that means the projects weren't speculative. Customers actually approached PLD with specific, customized long-term needs. This effectively de-risks the development process significantly and ensures immediate high-demand revenue upon completion. That build-to-suit activity is really their core development expertise. But the most dramatic part of this blue side pivot, the really headline-grabbing part, is their aggressive move into data centers. And this directly addresses what might be the biggest infrastructural challenge facing the global economy today: the power bottleneck.
Right. This is the massive, almost insatiable power demand being driven by the AI explosion. This is completely transforming the calculus of real estate development, isn't it? Making reliable, high-density power access the single biggest constraint on industrial and digital growth. It seems to be surpassing even the challenges of securing land or capital now.
And PLD is, you could argue, uniquely positioned here. They are capitalizing on this by leveraging their existing portfolio of infill land, remember, the land that is already zoned, already permitted, and crucially, already connected or near existing power grids close to massive urban and industrial centers. They are actively pursuing a massive build-out. The numbers are pretty staggering. They're stating they have already secured or are in advanced stages for 5.2 gigawatts GW of power specifically allocated for data centers.
5.2 gigawatts. That's an astonishing amount of power capacity.
Right.
For our listener, How do we even visualize that scale? And what's the financial implication of securing that much capacity and the associated land? What's the opportunity here?
Well, 5.2 GW is enough energy to power millions of homes. But in the context of data centers, it represents the digital backbone of the next generation of AI and cloud computing. Financially, this secured power translates to a potential $15 billion investment opportunity. And that's just to deliver the asset as a powered shell, meaning the core raw structure that is ready for the data center equipment, power ready.
$15 billion dollars just for the shell.
Just for the powered shell.
Huh.
PLD seems to view this almost as an obligation to their hyperscale customers, but also obviously an incredible source of future revenue. The long-term aim they've stated is to achieve 10 GW of capacity potential over the next decade. So they're thinking very big.
But wait, I have to interject here. I have to challenge the execution risk a bit.
Sure.
PLD is, as we've established, a world-class industrial landlord. They specialize in concrete, trucking docks, warehousing efficiency. Now they seem to be fundamentally pivoting into utility infrastructure managing, complex power sourcing, high-density cooling, massive construction projects that operate on a totally different timeline and complexity scale than a standard distribution center.
Yeah.
Are they potentially taking on too much complexity too fast here? Is there a risk they stumble?
That's the core risk, absolutely. And it's precisely why the strategy is rightly labeled high risk, high reward. Management is essentially betting that their deep expertise in securing permits, managing these complex infill sites, and handling the relationship with these massive hyperscale clients, they're betting that outweighs the internal learning curve required for the utility side of things. Crucially, though, they stressed on their calls that every single megawatt they believe they can deliver over the next 3 years is already in dialogue with potential customers.
Already in dialogue. Okay, that's important.
It suggests that the market demand is so urgent, so intense, that customers are perhaps willing to work closely with PLD on delivery timelines and maybe even shoulder some of the risk themselves. That could mitigate some of the complexity of the pivot.
That immediate demand validation is definitely key. This whole blue side strategy, it really sounds like they're fundamentally moving from being just a real estate company to becoming more of a utility infrastructure provider. Which leads us directly into the third growth driver you mentioned, energy and sustainability integration.
Absolutely, it all fits together. They are turning the massive, previously passive flat rooftops of their logistics centers into active, revenue-generating, grid-supporting assets. PLD is on track to deliver 1 gigawatt of solar and battery storage capacity by the end of 2025. That's a significant increase from their prior capacity goals. They're essentially creating these microgrids on their properties, like the 9-megawatt system they have operating in Torrance, California.
So they're literally embedding sustainability into their physical assets, providing tenants with stable, localized power sources, and turning their real estate into an active revenue source that also supports the local grid. It's quite integrated.
It's vertical integration that secures a competitive advantage. By controlling the solar generation and the battery storage on site, they reduce operational risk for the tenant, especially during peak usage times or periods of grid stress, and they monetize space that was otherwise inert, just sitting there. This integrated approach to physical and power infrastructure is precisely why they believe their premium valuation is justified.
Okay. We've established the defensive foundation, the MTM growth engine, and this really ambitious future strategy. Now, as per our mandate, we absolutely must define the risk because PLD does trade at a premium, and that premium assumes not only perfect execution on this blue side strategy, but also, reasonably favorable macroeconomic wins. So what are the key risks and headwinds that were flagged in the sources?
Well, the primary friction point is financial, and it's kind of a necessary cost of their aggressive growth. It's the increasing cost of new debt servicing. While their legacy debt is incredibly cheap at 3.2%, the cost of the new debt required to fund all this development is much higher now. And that is starting to squeeze margins on new projects.
Yeah, you can see that friction clearly in the interest expense line item on their financials. Consolidated interest expense increased substantially. It reached $742 million year-to-date through September 30, 2025. That's up from $632 million in the same period the prior year, 2024. That's nearly a $110 million jump in debt servicing costs in just 1 year.
And that increase is driven directly by the new debt issuances required to fund their growth pipeline. That includes $2.9 billion in senior notes issued just year-to-date in 2025. Crucially, that new debt carried a weighted average contractual rate, or WACR, of 4.3% upon issuance.
Okay, so compare 4.3% on the new stuff to their legacy rate of 3.2%.
Exactly. That widening gap means that while their A rating still secures the capital, they can get the money. The cost of that capital is rising, and that necessarily compresses the potential returns on new logistics projects compared to the ultra-low rates they enjoyed just a few years ago.
That makes sense. The next major risk is more of a macro risk. Valuation pressure from sustained high interest rates. This ties directly into the concept of capitalization rates or cap rates for real estate.
Right. This is a textbook concern for any real estate holder, especially one with such a massive portfolio. Sustained high interest rates generally cause cap rates to rise. Why? Because investors demand a higher yield from real estate assets to compensate for the higher opportunity cost of just holding cash or buying fixed income products, which are now yielding more. When cap rates rise, assuming the net operating income NOI stays constant, the implied valuation of the underlying asset portfolio generally falls. Given PLD's massive, multi-billion-dollar asset base, this creates a theoretical downward pressure on their net asset value, or NAV.
But they do have a cushion against this theoretical pressure, don't they? Something about their replacement cost buffer.
They do, yes. They estimate that replacement cost rents, basically what it would cost to build a comparable new facility today, are about 21% above current market rents. This massive buffer provides a strong long-term defense because, eventually, market rents generally have to rise to meet the cost of new construction. Otherwise, nothing new gets built. However, the sources did note that there isn't yet enough market tightening, meaning enough demand relative to the existing supply out there, for that replacement cost buffer to immediately drive current market rental growth upward significantly. So, until that tightening occurs, the cap rate risk remains a relevant valuation pressure point to watch.
Okay, moving to the operational macro risks, just the broader economy. We know the long-term demand seems structurally positive.
Yeah.
What about short-term sentiment? Any issues there?
Well, macro uncertainty definitely remains a bit of a drag. Specifically, the sources cited how ongoing discussions around tariffs and policy uncertainty, things like the proposed import policy shifts introduced earlier in 2025, caused a noticeable, though maybe temporary, slowdown in new leasing decisions during part of the year.
So companies get hesitant.
Exactly. When major global supply chain firms face unpredictable political or trade landscapes, they tend to defer making those big, long-term, multi-million-dollar lease commitments until they have more clarity. Even if their underlying need for the space hasn't actually disappeared, they just pause.
Okay. And finally, there's a specific operational headwind that's expected in the near term, impacting the 2026 outlook specifically, something called the deployment drag. What's that about?
This is purely a timing issue related to the development cycle. Think of it like manufacturing a complex product that has a mandatory, say, 9 to 12-month lead time from start to finish. Because PLD intentionally had somewhat later development starts back in 2024, when global market conditions were particularly uncertain, that slowdown in the input phase naturally translates into a bit of a deployment lag on the output side. This timing issue will impact the contribution of new net operating income expected in 2026 from those developments finishing. It's not seen as a long-term demand problem, it's more of a short-term delayed revenue timing issue that will temporarily dampen some of the growth metrics next year.
Got it. Okay. That gives us a pretty complete picture, I think. The defensive floor, the aggressive ceiling, and the near-term friction points. Let's try and wrap this up with a look at leadership and the final verdict, but we probably should acknowledge the major leadership transition underway.
Yes, absolutely. The co-founder, chairman, and CEO, Hamid Moghadam, who has really been the anchor of the company for decades, is transitioning from the CEO role to executive chairman. He presided over, I think the number was 112 earnings calls across a remarkable 42-year tenure.
112 calls.
Yeah. That kind of leadership continuity is incredibly rare, and any transition of this magnitude is certainly a factor investors have to note and consider.
Yet the sources seem to heavily emphasize that the company's success isn't necessarily reliant on just one individual, but more on the foundation and the culture he institutionalized. They often quote that resilient mindset he fostered. If you don't like change, you're going to hate extinction. That cultural defense seems to be what allows them to embrace the kind of self-disruption inherent in this high-risk blue-side strategy. It feels like they're willing to break their own successful business model to stay ahead.
I think that's a fair assessment. And when we synthesize the entire investment thesis, this combination of defense meets aggression, the fundamental reality is that Prologis exhibits exceptional structural resilience. They maintain extremely high occupancy, as we said, 95.3%. They demonstrate that significant 290 basis points of outperformance versus the market average, and they possess that guaranteed contractual growth through long-term leases with built-in escalators, plus that massive MTM upside potential.
The market clearly knows this compelling story, though, the story of durability and disruption, and the valuation certainly reflects it. The stock trades at a premium PFO multiple of 27.9x. That is meaningfully above its own long-term average multiple of around 25.7x. So you are absolutely paying up for safety and for this future growth potential here, no question.
And our final verdict, based on this analysis, is that this premium appears justified. PLD has definitively moved beyond being merely an industrial REIT. It is operating now as a long-term compounder and truly an essential infrastructure provider. It benefits from multiple powerful structural trends, e-commerce, potential reshoring, and certainly the AI boom. The defensive moat of their irreplaceable locations, combined with this aggressive, future-focused pivot into high-value data centers and energy, we believe it validates that premium valuation. It seems to fundamentally outweigh the near-term financial friction points like the rising debt costs and the macro uncertainty surrounding cap rate sensitivity and that temporary deployment drag.
It really does seem to be a company that has mastered the art of disrupting itself before anyone else can disrupt them. Well, thank you for joining us for this deep dive into Prologis Do It. As you reflect on the sheer scale of PLD's operations and its absolutely foundational role in global commerce, maybe consider this final provocative thought. If this company is truly the central nervous system, as we discussed, and we just established they are capturing potentially 49% more rent as old leases roll over, well, we have to consider the potential long-term systemic inflationary effects on essential goods when PLD's built-in MTM growth is eventually realized across the entire logistics sector, and that significantly increased cost is inevitably passed through to the end consumer. What does that mean for broader inflation down the road? Risk defined, portfolio protected.